Right now, as we look at the live tape, Rezolve AI PLC is trading at exactly $3, currently down 21 cents or 6.41% in today's session as of this morning. We are witnessing a critical test of support at this precise moment, and the acceleration of selling pressure, pushing the stock down over 6%, indicates that the market is rejecting the current valuation levels with increasing aggression. When you see a stock hovering exactly on a whole number, like $3, it is rarely a coincidence, it is a battleground. The expectation for a company in the AI sector, especially one promising to disrupt commerce, is that it should be defying gravity, riding the coattails of giants like Nvidia stock, or at least holding its ground. The reality, however, is a harsh lesson in market liquidity and skepticism. The market is not buying the narrative today, it is selling the risk. This disconnect between the glossy promise of brain power and the gritty reality of a red ticker is exactly where we need to focus our analysis. The intraday movement is telling us a story of capitulation. Earlier, the stock was trying to find footing, but this slide to a loss of over 6% suggests that bids are being pulled. In the world of online investing, this is often referred to as bid exhaustion. Buyers who were stepping in at $3.15 or $3.10 have realized they are fighting a losing battle, so they step aside. When they step aside, the price drops vertically until it finds the next brave soul willing to catch the falling knife. For those of you watching this on your Fidelity mobile app or monitoring the charts via Interactive Brokers trading stations, the volume profile likely shows spikes of selling volume, indicating that this isn't just retail noise. This is likely institutional de-risking or algorithmic stop losses being triggered. Let's talk about the psychological level of $3. In the psychology of self-investing, round numbers act as mental barriers. If you own the stock and you see it break $3, your lizard brain screams, "Danger!" It signals a drift toward the $2 range, which feels significantly more desperate. This fear triggers sell orders. We are seeing that play out in real time. The expectation was that Rezolve AI would announce a major catalyst to reverse the trend. The reality is that silence from the company often speaks louder than press releases. In the absence of positive news, the default direction for a speculative, unprofitable tech stock is down. This volatility is a nightmare for the passive investor utilizing Schwab Intelligent Portfolios or similar set-and-forget strategies, because this stock does not fit that mold. This is an active trader's environment. The volatility we are seeing, a 6% swing in a single morning, is attractive if you are on the right side of the trade, perhaps shorting it, but it is destructive if you are holding long positions in an individual brokerage account hoping for a rebound. The hope trade is one of the most dangerous strategies in the market. You can't pay your mortgage with hope, and you certainly can't shore up a balance sheet with it. Comment below how many shares of Rezolve AI you currently hold and what your plan is if it breaks below the $3 mark. Are you looking to average down, or are you setting a hard stop loss? We must broaden the lens to understand why this is happening. The broader AI trade is maturing. In 2023 and 2024, anything with AI in the name could raise capital and see its stock price soar. Now in late 2025, the market has become discerning. Investors are demanding to see the path to profitability. They want to see the unit economics. Rezolve AI claims to offer agentic commerce, essentially AI that can act as a salesperson and checkout clerk all in one. It's a brilliant concept. If it works, it reduces friction in buying, which is the holy grail for retailers. But the market is asking, where is the adoption? If major retailers were adopting this en masse, the revenue growth would be undeniable, and the stock would likely be trading much higher than $3. The fact that it is struggling suggests that the sales cycle is longer and harder than anticipated. This brings us to the difference between Tesla stock or Apple stock and a company like Rezolve. Tesla and Apple have immense cash flows that act as a floor for their stock prices. They can buy back shares. They can pay dividends. Rezolve AI is likely in a cash burn phase. They are spending capital to grow. When a company burns cash, it is dependent on the capital markets for survival. If the stock price drops too low, raising more capital becomes extremely expensive and dilutive to existing shareholders. This is the death spiral risk that sophisticated investors using Fidelity Wealth Management Services are acutely aware of. They avoid stocks that might need to raise cash at distressed valuations. That avoidance creates a vacuum of buyers, which exacerbates the drop we are seeing today. For the retail trader using the Robinhood app or SoFi Active Investing, the allure of a low-price stock is strong. You look at it and think, if it goes back to $10, I triple my capital. That is the expectation. The reality is that a stock trading at $3 can go to zero just as easily as it can go to $10. The percentage loss from $3 to $0 is 100%, just the same as a drop from $100 to $0. The low price is not a discount. It is a price tag that reflects the market's assessment of the risk. Let's dissect the short squeeze potential. Often stocks that are beaten down like this have high short interest. Short sellers are borrowing shares to sell them, betting the price will go lower. If Rezolve AI were to drop a massive press release today, say a partnership with Amazon or a massive adoption metric, those shorts would rush to cover. They would have to buy the stock to close their positions. This would create a frenzy of buying, potentially launching the stock upward. This is the scenario that keeps the bulls holding on. But timing a squeeze is like trying to catch lightning in a bottle. Most of the time you just get wet from the rain. If you are looking at Fidelity ETFs or sector funds, you will notice that most conservative funds don't touch companies with this profile. This means Rezolve AI lacks the passive bid, the automatic buying that happens when 401ks buy into index funds. It relies entirely on active selection. This makes the price action jagged and violent. There is no cushion. When the active traders leave, the floor drops out. We need to talk about the product itself, Brain Power. The name implies cognitive strength, a powerful AI brain. The technology allows for instant checkout from any media, audio, video, or image. Imagine pointing your phone at a TV screen and buying the jacket the actor is wearing instantly. That is the promise. It uses audio watermarking and image recognition. It's objectively cool technology. But cool does not always equal profitable. The challenge is integration. Retailers have complex, messy legacy systems. Plugging a new AI brain into an old inventory system is a nightmare. This friction is what slows down growth. The market, in its infinite impatience, punishes slow growth. Furthermore, we have to consider the competitive landscape. Google has Google Lens. Pinterest has visual search. Instagram has shopping tags. The giants are already sitting at the intersection of discovery and commerce. Rezolve is trying to carve out a niche as the independent, agnostic player. It is a David versus Goliath battle. While everyone loves an underdog story, in the stock market, Goliath usually wins because Goliath has the balance sheet. This is why you see institutions hedging their bets using interactive brokers platform option strategies rather than going all in on the equity. Let's discuss the macro environment. We are assuming a context where interest rates are a major factor. If rates are high, the discount rate applied to future earnings is high. Rezolve's big earnings are projected for the future, not today. Therefore, high rates crush its present value. If the Federal Reserve indicates a higher-for-longer stance, it is a headwind for RZLV. Conversely, if rates are cut, this is exactly the type of high-beta stock that could rally. But betting on the Fed is a dangerous game for the individual brokerage investor. The volume today is a critical indicator. If the stock is down 6% on low volume, it might just be a lack of interest. But if it's down on high volume, it means investors are fleeing. High volume selling at a support level like $3 is bearish. It means the supply of shares overwhelms the demand. It suggests that people are not just selling to take profits. There are likely few profits to take at these levels. They are selling to stop the pain. They are capitulating. If you are using investing sites to do your research, be wary of the echo chambers. Forums can become support groups where everyone reinforces the bullish thesis while the stock crumbles. You need to look at the hard data. Look at the cash balance. Look at the burn rate. Look at the insider selling. If the executives are selling shares while telling you to buy, that is a divergence you cannot ignore. Now let's pivot to the future outlook. What happens next? Scenario A, the turnaround. Rezolve proves the skeptics wrong. They announce that their ARR, annual recurring revenue, has doubled. They show a clear path to being cash flow positive within 12 months. In this scenario, the stock at $3 is a historic bargain. The reality would exceed the expectation of failure. Scenario B, the stagnation. The company continues to sign small deals but burns cash. The stock